It's always hard to know, but there seems to be a baked-in expectation that interest rates will stay low for a very long period of time, and that might not be true. And equally, inflation is the other thing, and the two go hand in hand. So I think one of the more dangerous ends would be to expect low inflation and low interest rates for a very extended period of time. Might not work out like that. The companies that have done really, really well over the past 5 or so years, even longer, 10 years, have been companies with, I would say quite a lot of debt, because they've benefited greatly from reduced interest costs with the reverse of leverage. And infrastructure and utility stocks are a case in point. They've done very, very well. And I'd probably avoid those. They've also offered what investors want, these defensive and stable earnings streams, as a yield proxy. But of course, if interest rates go up, they've got a double whammy. Suddenly there's a different place for investors to seek refuge and get a return. And then the actual impost on the company's earnings will be that much worse from increased interest rates on their debt. So those are probably the two areas I would concern myself with. Higher interest rates might also be very bad for the banks. The ability of their loans to service themselves and impairments, etc., are heavily correlated with interest rate cycles. The Australian consumer's got a lot of debt. Now, there's other things on the other side of the ledger. We also have significant superannuation balances relative to other countries. But it's not inconceivable that credit doesn't grow going forward, and that the cost base of the banks does still continue to grow with inflation. And the banks have long had these positive jaws, as they like to call them. There may well be negative jaws going forward, and that would be a reasonably benign outcome if credit growth is in fact negative as people de-gear. That could be terrible for the banks, and that would be independent of any impairment cycle on their loans. So I just think there's quite a few things that could go wrong, and probably only one thing that can go right for the banks from here, and that is that we have credit growth in the low single digits going forward. I would think that's quite an optimistic outcome from a bank perspective, but it might be right. I mean, no one really wants to see the banks fall on tough times. It'll impact us all. And so we haven't been waving the flag that the banks are imminent, are about to blow up or have some earnings headwinds. It's more been about where we can find relative value relative to the banks. And that's where most of our focus has been. It's probably a necessary development, and probably the type of thing that all the banks will need to do in the fullness of time. It doesn't surprise us. Andrew Thoburn specifically said that if they were not listed, this is something he commented on 2 or 3 years ago, and didn't have to report quarterly to investors, that he would radically change the cost base of the company, rationalize the branches. And so these things, I think, are necessary things and development that all banks will need to undertake at some stage. And there's been quite a lot of technological shift. So I think this is a stay in business, remain competitive expenditure, and whilst the investment community may not have liked it, I think it is absolutely necessary to ensure the relevance and long-term survival of NAB and probably the other banks.